This is the video lecture on internal control. Now, in every business, we're going to have an internal control system. And the reason that we're discussing this is because it's actually the responsibility of the accounting department to design and to implement the internal control system. And the purpose of this system is to ensure accuracy and also to prevent fraud. And we also want to protect all the assets of the company. So that's why we have to have this internal control system. And if you think about it, as a business owner, it would actually be impossible for you to be at the business 24 hours a day, 7 days a week. And it would be impossible for you to be in two locations at the same time. So no one person can really control and oversee everything. So the idea is that if we have a good quality system of rules and regulations in place, hopefully that system will maintain the control when we actually can't be there ourselves to oversee everything. Now, this system will have 7 key principles, and we always look for all 7 of these key principles as a good quality indicator of an internal control system. The first principle is to establish responsibilities. And that simply means that we need to have clearly defined roles, clearly defined responsibilities. Everyone has to know their role in the business. Everyone has to know what they're responsible for. And that way, if there is a potential problem, something comes up that seems out of place or seems like there's a problem, we know exactly who to talk to about that. We know exactly who is responsible. So that's a very important aspect of internal control. The next principle is to maintain adequate records. We want all of our business records to be up to date and accurate. The key is, if there's going to be a potential problem, we want to find that problem as soon as possible so that we can deal with it. If we let these problems continue, they can actually get out of hand. So you want good quality, up-to-date records. And in fact, a criminal or a person out there who wants to commit fraud, they actually look for businesses that have poorly maintained records. That's their ideal target, because a person that has bad records, it may be a long time before they ever realize that fraud is being committed, if they ever even realize it. So it's very important for those records to be up to date. The third principle is to insure assets and bond key employees. So obviously, all the assets that we own, we definitely want to insure those assets so that they will be protected. And also, when we have certain employees that have a sensitive position, especially anyone that handles money, we want that person to be bonded, just as a safeguard. The next principle is to separate record keeping from custody of assets. What that means is the same person who does the record keeping should not also be the same person who has physical access to that asset. Because if those two duties are not separated, a person could actually manipulate the records. For example, they could steal inventory and then they could doctor the paperwork to make it look as if the inventory never arrived. So it would be too easy for a person in that situation to commit fraud. So we definitely want to separate those two functions. And the next principle, divide responsibility for related transactions. So any kind of transaction that has multiple parts, we want to divide that responsibility up as much as possible. And a good example of that is that any employee who has the ability to sign the checks, that should also not be the person who actually calculates and prints those checks, because obviously they could just print themselves an extra check and then sign it. So any kind of related transaction like that, we want to divide up those responsibilities as much as possible. And it doesn't guarantee that there won't be fraud, but it certainly reduces the chances. And then the next principle apply technological controls. There are a lot of things we can do with technology. We can have security cameras. We can have time cards so that we know exactly when a person entered and left the premises. We can utilize many different technological controls to help us strengthen our internal control system. And then the final principle is to perform regular reviews. We definitely do not want to become complacent in our internal control system. We want to constantly review, make sure that it's still effective, and make sure that it's up to date. So that's a very important principle. And if we follow all these principles, hopefully we will have a good quality system that will certainly reduce the chances of fraud. And if fraud does occur, hopefully we will find out about that and be able to take the necessary steps to correct that problem. Now, to specifically talk about certain controls, the first control would be the control of cash. The reason we want to control cash is that out of all the assets that we have, this is the one that is the most susceptible to fraud. So we're going to have a lot of different ways all throughout this lecture that we're going to talk about controlling cash. And one of the simple ways is simply this: minimize the amount of cash. Keep the least amount possible of loose cash. You don't want to create any kind of a temptation or any kind of a potential problem. And as much as possible, pay for everything with a check. If we mostly pay for things with a check, that means we have less money around, and the great thing about a check is that it creates automatic documentation and proof of what we paid and what we didn't pay. And obviously, anybody that has access to cash, we want to maintain very close scrutiny on those employees. Now, to apply specific cash controls, one of the problems would be cash that we receive over the counter. We always will have employees that are handling cash and collecting cash from customers. So any of these over-the-counter collections have to be monitored very closely. And one way to do that is to utilize the electronic record that's inside every cash register. At the end of the day or at the end of a shift, we want to take a look at that record and actually compare that to the actual amount of cash that is there to make sure that everything balances out. And if it doesn't, we might have to have a new account called cash over and short, and we could use that account to resolve any discrepancies that there might be. So if you take a look at this example, we have a cash register record which actually shows $650. That's what should be in the register. But when the money was counted, they actually had $654. So we actually have more money than what should really be there. So that is an overage of cash. So that means evidently we shortchanged a customer throughout the day. So things like that do happen on occasion, and usually if it happens, it tends to be a very small amount. So to record that, I'm going to debit cash, and notice that when I debit cash, I'm debiting for $654. And that's because that is actually the physical amount of cash that was actually there in the drawer. But then when I look down here at the credit to sales, I'm crediting sales for $650, which is what should have been there. And then that discrepancy of $4, we will credit that to the cash over and short. So that way we have the ability to record that journal entry and resolve that discrepancy. If you look at this second example, this is a little different. This is actually a shortage. In this example, the cash register record shows $554, but when the money was physically counted, it was actually only $524. So that's a shortage. So again, we have, just like last time, a debit to cash and a credit to sales. and we use the actual physical amount, which in this case is $524 for cash. We use what it should have been for sales, which is $554, and that difference of $30 goes to cash over and short, but this time it's a debit. So as you can see, cash over and short is used for both shortages and overages, and it can sometimes be a debit or a credit. It can be wherever you need it in order to make that journal entry balance. Now in cases like this where we have a shortage, there are different explanations. It could be an accident, but if this starts to happen a lot, and especially if it starts to happen a lot with the same employees, then that's going to give us a reason to be a little bit suspicious. So we're always looking out for things like that as part of our cash control.